Well, U.S. stocks, they are falling today. The Dow right now is off more than 600 points, and the S&P 500 and the NASDAQ are each off on a percentage basis by more than 1% right now. The sell-off is coming after August CPI report fueled bets that the Federal Reserve will cut by 25 basis points instead of 50 basis points. Here with more on the market moves, we've got Eric Lynch, Managing Director at Sharp Investments. Eric, thanks for hopping on, taking the time here with us. Help us make sense of this. It seemed like 25 basis points was largely already priced in. So why does it seem that the markets are upset at the possibility that and the probability certainly shifting towards that reality of a 25 basis point cut?
Yeah, good to be here, Brad. Thank you. So, yeah, I think this is a collective giant recency bias from the last, couple decades of low interest rates. And so, most investors are just so used to rates being lower than where they are today. And given some of the disappointing economic prints from the last couple of months, there was a pretty good hope that the Fed could very well cut 50 basis points next week. With the fact that the services index or pricing was up year over year 4.9% in the CPI print, i.e. core CPI is still very sticky. The Fed can't cut with impunity. And so I think investors are disappointed today.
And so with that in mind, where would investors be apt to really place their attention when it comes to the pathway of rate cuts?
Yeah, well, I think that's a good question. Although, whether it's 25 or 50 or what kind of the time frame is over the next several Fed meetings, I think what's becoming more apparent, Brad, is that investors are getting more concerned about the other mandate of the Fed, which is full employment. The fact that it's deteriorating, the fact that while still hanging in there, the economy is still printing, good overall GDP, levels in Q2 and Q3 still is forecast to be 2.5. Nevertheless, whether it's jobless claims or it's new jobs or job openings, those numbers are softening. And so if you look at what's happened since the summer really began, low volatility stocks are starting to work versus kind of momentum stocks that have been leading, previously. That's because, investors are just concerned about what the outcome is for the economy for the first time in a long while.
Yeah, certainly. And so as you're kind of continuing to look through the data points that the Fed is going to be watching, not just going into their September meeting, but even further out, there's been a lot of focus on the employment front as well. How can what we see within employment continue to get the Fed towards their larger dual mandate targets here, and how the markets may appreciate that?
Yeah, well, I think the Fed has already outlined, since Jackson Hole, that they're gotten decidedly less hawkish on CPI or inflation. In today's print, even though core services remains kind of sticky, core CPI remains sticky, and that's a negative for drastic reduction in rates. It is nevertheless because of gasoline, food moderation, things like that, goods continue to deflate. That is still taking some pressure, and so I think the Fed has some ability to keep reducing rates. What's really going to be interesting, Brad, going forward is what's the economy going to do? Are we really going to have a soft landing? Right now, we are still doing all right. And if the Fed can just mildly reduce rates and the jobs, remain kind of steady, growing, maybe not as robustly, but still growing, then I think, we're all going to start looking more and more closely at earnings growth, which I think we all need to remember that Q2, we had 11% earnings growth, and it was more broad-based outside of tech. So things are not all bad. I think it's time to focus on fundamentals.
And so with that in mind, and you're right on the earnings growth and the broadening that we were starting to see outside of tech. I was noting that actually yesterday with one of our guests per a BlackRock weekly market commentary that they had sent through to our team here. And so all of that considered, where are some of the top buying opportunities that even if we were to see further volatility or further pullback that would initiate some type of larger dip, where are those dip buying opportunities that you're keeping an eye on?
Well, I think this was a period of time, Brad, where the laggards could become leaders. In 2023, things like healthcare and staples and financials did nothing. Tech was up over almost 50%, consumer discretionary communication services all up over 40%. So you've got this huge kind of valuation spread between tech and really everything else. And so what's interesting about Q3 is as volatility has spiked since it started, and IT sector is down 8%, quarter to date. Things like the real estate sector are up 15%. Staples are up 9%. Healthcare is up 6%. So it's really, a good time to, again, broaden out your portfolio without a lot of risk. These are defensive categories and sectors. And so even if we have a harder landing or more softening in the economy than we want, a lot of these businesses are still going to probably produce pretty good earnings independent of the economic conditions. And so because the multiples are so low, you're getting a re-rating. So I think that's a really good place for investors to look for their equity exposure.
Eric, thank you so much for joining us here today. Eric Lynch, Scharf Investments Managing Director. Good to see you.
Nice to see you too, Brad.